Good evening, everyone, and thank you for joining us. Welcome to Ironwood Wealth Management's Market Insight webinar for Quarter 4 of 2013. My name is Nicholas Basso, and I am a Portfolio Administrator in Ironwood's Investment Division. Tonight, it is my pleasure to introduce our featured presenter, the Chief Investment Officer here at Ironwood, Mr. Sean Rogers. Sean is a charter holder of the Financial Analyst designation, and he also serves as Ironwood's primary investment strategist. If anyone has any questions for Sean during the presentation, please feel free to type those questions into the box on your right-hand webinar panel. We will definitely do our best to address all of the questions at the end. And now, without any further delay, please join me in welcoming Sean to lead this evening's presentation. Sean?
Thanks, Nick. Good evening, everybody, and welcome to another edition of the Ironwood Quarterly Insight Call. We had quite the quarter this quarter. Government shutdown, debt ceiling argument or battle or debate, whatever you want to call it, along with new all-time highs on the S&P 500, and corresponding new all-time highs in S&P 500 earnings. These are just a few of the things that we're going to discuss this quarter. We've got a lot to go over, so let's begin. First, we need to pay the attorneys. I'll keep it here for a second. All right, topics to cover here today. We're going to go over the returns and the environment of Q3. We're also going to map out the rest of this year, speak a little bit about 2014 and what we expect, and then how that's going to change the portfolios and what our investment implications are going to be. So I usually like to start off kind of with a little bit of perspective and show kind of where we've come from. It's been a turbulent past 5 or 6 years, to say the least. But this picture really says it all. It's not timing the market, it's time in the market. If you were to have invested on what is arguably the worst day to invest in the last 20 or 30 years, it would have been October 9th, 2007. And if you would have invested 100% into the S&P 500 index, which is a 100% equity, domestic equity portfolio, you would have seen your investment basically cut in half in a very short period of time. And then the subsequent 4 years, you would have seen that investment actually get past where you originally put in, and actually you'd be up 22.6% over that entire period of time. Now, it takes the right time and the right time frame in order to allow your investment to do that. But I do like to start the presentation to kind of see where we've come from, and this is just since 2008. So the second thing we like to look at here is, okay, well, let's look a little bit longer history here. Here's a 16-year history, and I bring this up for a couple of reasons. One, in history, there have been a couple of periods of time that last between 12 and 16, 18 years where the market doesn't really go anywhere. We've just gone through a 16-year period of time where we've kind of gone through that, and this is the exact depiction here. You know, back in '97, we were at about 800 on the S&P. In '99, somewhere in '99, we crossed 1400, and we peaked out at 1527, only to go all the way back down to 777 on the S&P in the 2001-2002 recession, only to climb back up to 1565 before the financial crisis, which brought us all the way back to 677. And now you can actually see that we've broken through this trading range. You know, if we were to draw a line here and we were to draw a line here, we've got this trading range that we've been in over the last 16 years. We've just broken through, and actually this was at the end of September. We were at 1682 on the S&P. As of today, we're at about 1750. So we've broken through that trading range, which is one positive. But the other reason I have this slide here is to show the different dynamics that were at play, because there's a lot of folks out there who think, okay, well, I've been invested and I started investing in the 90s, and I've seen the stock market go up and then go down and then go up and then go down and then go up, and now it's time to go down. So what I'm here trying to show is that not all of these market tops are the same. You can see here in 2000, although we were at 1527 on the S&P 500, that equated to 25.6 as a PE multiple. So investors were willing to pay 25, almost 26 times the forward earnings that a company was going to get. The dividend yield at the time was 1.1%, so that's relatively low compared to where we are now. And the 10-year Treasury was at 6.2%. So you could have locked in a 10-year return of 6.2%. In today's age, that would be a very good return to lock in as a 10-year Treasury, a very safe investment. Unfortunately, that's not where we're at right now. So back then, you know, folks were making very good returns in the stock market. In fact, some people were making 100% returns in 1996, 97, or I should say 98, 99, 2000, where they were riding this market up, and basically you threw a dart at the dartboard. Well, we got a little bit overvalued on equities, and especially in relation to fixed income. And we'll talk about this a little bit more later in the presentation. 2007, not all that, you know, we weren't overvalued really on equities in 2007. We were at 1565. PE multiples were at 15.2, which is well within reason. However, we were in a housing bubble, and we had a financial crisis, and banks really took it on the chin by really doing some loans that they probably shouldn't have done. And it affected the entire economy. We all know what we went through during the 2008 financial crisis. That didn't really have to do with a stock bubble. It was more of a housing bubble. But you can see the PE multiples were within reason. The dividend yield was still pretty low, and our alternative investment, a 10-year Treasury, was earning 4.7. So now we fast forward to September 2013, and I'm going to adjust these numbers a little bit to kind of go current. We're at 1750 on the S&P, which equates to about a 15 multiple, and we still have a 2.1% dividend yield, and our alternative investments being safe fixed income, 10-year Treasury at 2.6. So this is a completely different environment than the two previous environments that we've been at. I would argue that stocks are still relatively inexpensive, although not nearly as much as they were. We're getting closer to fairly valued, and we'll go through these. We'll go through some of the reasons why I think that in the further discussion here. One thing I did want to point out is late last year, when we had some government issues and we were talking about taxes and changes in taxes and sunset provisions and the sequester, the S&P actually on November 15th closed at 1353. 400 points later, in less than a year, is where we stand today. That's up 30% since all of the government fighting. We've had 3 or 4 government fights now during this recession. Each time volatility has spiked, but has been reduced from the previous government battle. So the market and market participants are getting used to these battles. Although volatility is still spiking up during these periods of time, it's not nearly as much as the previous crisis. So we're getting used to this governed by crisis that we seem to be in right now. So anyway, those are some of the things I want to discuss. Here's a slide on the third quarter results and environment. You can see in lieu of the government shutdown, the debt battle, the market still climbed to new highs. Does the market know something we don't? I don't know. It might. Actually, the market itself is a leading economic indicator. And if you look at some other leading economic indicators like For example, the ISM numbers in August, non-manufacturing, which is the biggest U.S. sector, for August came in at 58.6, which is a 5-year high. In October, it slowed a little to 55.4, but that's in line with some confidence numbers that might have been affected by the government shutdown. So that doesn't surprise us, but a 58.6 number in August is very strong. Couple that with manufacturing for September was at 56.2, which is a 20-month high. These are some leading economic indicators that really have been missed or not really talked about very much, because all we've been talking about this entire quarter is the government. So now the government's out of the way. The previous quarter, all we were talking about is the Fed. The Fed is back in everybody's conversations now, and we'll talk a little bit about that going forward here. But during the quarter, domestic equities did well. S&P was up 5.2%. Small cap was up 10.2%. International equities outperformed domestic. The developed international index, known as EAFE, was up 11.6%. Emerging markets was up 5.9%. Something that was very important during the quarter was the 10-year Treasury rate increased from almost 2.5 to 2.61%. However, prior to the government reopening, the 10-year Treasury actually got really close to 3%. So we'll talk a little bit about the spike in interest rates. The U.S. job market continued to improve, but at a slightly slower pace than it had been. We definitely want to keep an eye on that. Tomorrow we have a jobs report. It's coming out a little late, about a week late because of the government shutdown. We got September's numbers late. We're getting October's numbers late. November should be right on schedule. So here are some asset class returns. We can look here at the third quarter. Like I said, developed international was the best performing sector, followed by small cap domestic, then emerging markets, then the S&P 500. Commodities were at 2.1%. Bonds actually rebounded from the previous quarter and were up 0.6%. Market neutral was about even, cash was about even, and REITs were down about 2.5%. The U.S. economy continues to improve. That's what we're seeing when you really stop looking at some of these government headlines. You can see that GDP is improving. The second quarter GDP came in at 2.5%. Quarter 3 GDP looks in line, and you can see that the output recovered compared to what we lost during the recession. We're over doubling that. We still have a ways to go because we have to make up for not only the amount we lost, but we should also have some growth in those periods of time as well. 2014 looks promising because business activities have picked up, and we will have less government headwinds. We'll talk about government headwinds and those subsiding. We'll talk about that a little later. The big unknown is the Fed and the response, and more importantly, not so much the Fed. I mean, they're important, but what we really worry about is the response from the bond market to the Fed. We'll talk about that as well. Cyclical sectors, these are slides that we have in every presentation, so I'm not going to spend too much time here. You can see since the recession, autos have been improving very significantly. We're back above the average level, but we had some pent-up demand that built up over the last 5 or 6 years. We're still getting through that. Housing hasn't quite recovered. We still have a lot of pent-up demand in housing. Interest rates still are low. We definitely need to keep an eye on them for the housing market. Real capital goods order had another leg up recently, which is businesses being confident and expanding and adding to their orders. So cyclical sectors look very positive to us. Consumer finance has improved significantly. We've talked about this in the past. Something we have not talked about is household net worth. Household net worth in 2012 improved by $6 trillion. In 2013, it also improved so far through September 30th, another $6 trillion, which is the net worth. When we have all-time net worth highs, consumers are going to feel a little bit better, and they're going to spend a little bit more. That's the net worth effect. So we're definitely seeing that play out. Another thing is consumers have had 4 or 5 years now with lower interest rates, where their biggest liability, which is almost 70% mortgages, they've been able to refinance that, and household debt service has come down, although it has spiked up a little bit recently, and that was due to the increase in interest rates. But you can see on the grand scheme of things, it spiked up just a tiny bit. So housing is still affordable. Interest rates, mortgage rates are still low relative to history. Net worth is at all-time highs. The consumer should be feeling fairly decent at these levels, which we think is going to equate to a little bit better holiday spending and some good Q4 GDP numbers, and we're looking that carries over into 2014 as well. Federal finances, a little bit better than they were. By definition, the sequester cuts have had an impact on the deficit. We had those sequester cuts, even though they might not have been surgical. They were, meat cleavers, but they still were cutting the spending. So the deficit has come down. It's come down significantly, actually. They also had an impact on the economy. We've had a negative impact on GDP by about 1% in 2013 because of the deficit declining as much as it has. That's a positive thing, but economically speaking, the less deficit you have from government, that's got to be picked up by corporations and individuals, which it has. So the negative impact on GDP has been about 1%, but that's been offset by lower energy prices, better consumer finances and spending, and better business activity. So back in late 2012, a lot of economists were saying, well, if the sequester happens, if it occurs, that could throw us into another recession. The sequester did happen. The deficit came down from 6.8% that we had all the way down to 3.9%. That's this drop right here that we see. That's a big drop. We had a deficit of 6.8% in 2012. All the way, we've dropped that deficit down to 3.9%. We still need to improve that, but that's a big deficit reduction in a 1-year period of time. A lot of economists would have predicted that a big drop like that in the deficit would cause a recession. It did not. We've done very well. Some of these other sectors of the economy have picked up. In 2014, we're going to have a similar deficit to 2013, and so that's just going to be a little bit less of a headwind. So that 1% negative to GDP is no longer going to be there in 2014. It's going to be that less of a hurdle to get over. So the government austerity we felt in 2013 won't really be present as much in 2014. So that's where we kind of stand with the federal finances. Unemployment or unemployment rate. Currently, we are creating jobs. It has slowed a little recently. We think that might be due to the government shutdown and the debt ceiling debate. Companies may have stalled a little bit while that argument was going on. We still haven't replaced the jobs we lost in the recession. We lost 8.8 million. We've only created 7.5 cents. We still have work to do here. It's going to take a little bit of time. Employment and unemployment rate is lagging. Is a lagging economic indicator. In September, the unemployment rate came in at actually 7.2. But we want to make sure that we're not, we don't think, okay, well, we went from 10 to 7.2, and that's, we're on the right track. A lot of this is due to the labor force has contracted over this period of time. So the labor force participation rate has really come down to a lot lower than we're used to levels, and that's been a big part of this reduction in unemployment. So we still need some private sector jobs to be created in order to get to the economic, so where everybody feels like the economy is really hitting on all cylinders, and for consumers really to start spending like we did before the recession. So I want to get back to the labor force participation. A lot of that has to do with just the demographics of the U.S. We have a lot of older workers, and over the last, coming into 2007, 2008 hit a lot of people's retirement goals. You go through a period of time where maybe you were invested too aggressively, or even if you were invested correctly, your portfolio still took a pretty big hit in 2008, and a lot of those folks put off retirement. Well, now that net worth is at all-time highs, those folks are saying, you know what, it's been 5 more years, 6 more years, I'm that much older, I have less retirement, my 401k, my retirement plans are bigger, I think I can retire. And they are. Baby boomers are retiring at an astonishing rate right now. And a lot of that has to do with this with net worth effect and the fact that a lot of those plans were put off during the financial crisis, and now things are improving and people think that they can retire now. Consumer price index, really not a worry for us at all right now. Inflation is way below 2%. The only thing I really want to bring up here is if you are on Social Security, your Social Security payments will increase by 1.5% for fiscal year 2014. That's much less than in history, but that's because inflation is much less, and that's tied to the CPI. So those Social Security checks won't be increasing as much, but your expenses shouldn't be increasing by that much either. So real yields are low, and your inflation is not very high, so your cost of goods shouldn't really be all that much more expensive than they were last year, and that's why only the 1.5% growth in the Social Security payments. But on the flip side, the Fed doesn't have to worry about inflation at these levels either. They can still continue to be easy without fears of creating inflation. And we'll get to that a little bit more when we talk about the Fed in subsequent slides. Consumer confidence, definitely improving since the recession. However, it did take a little bit of a hit here with the government shutdown and the debt ceiling argument. We believe those levels will come back now that that's kind of past us. But in January, January, February of next year, we're going to have to probably go through something very similar to this. So we'll definitely want to keep an eye on it. But we'll be past holiday season by then. So we believe that consumer confidence is going to kind of improve through the rest of this year. Interest rates, the Fed, and QE. This is where I want to spend a little bit of time. We think this is a very key determinant of the economic outlook for next year. You got a little bit of a taste of this summer. The Fed hinted, May 22nd, Ben Bernanke came out, told Congress that QE may be slowed by year end. This sent bond rates soaring. On June 19th, he gave more clarity on tapering, gave some benchmarks, said they want to be done tapering by the time unemployment is down to 6.5%. Bond markets really moved on this news. Interest rates went from 1.6% to 2.6% in a very, very short period of time. That definitely caught the eye of the Fed. They actually subsequently did not start to taper. We believe one of the reasons that they did not start to taper is because they didn't want any further movements in the 10-year Treasury. They didn't want bond rates to go any further than they already had. They wanted to calm the bond markets, if anything. which is one of the things they did. The other thing that was playing into their decision was the government shutdown, debt ceiling fight. Even though we've had some good economic data, they just didn't feel comfortable with the increase in interest rates that had happened just from them saying that they were going to taper, and the government shutdown and debt ceiling fight. So they actually, seems like, in our opinion, they're on hold until next year with the taper, but we definitely want to keep an eye on this. Here's something also to keep in mind, this money multiplier. It has just fallen off a cliff. Last time we talked, it was closer to 4. Now it's at 3. So this is the velocity of money. Banks just are not lending. Money is not being used for economic activity right now, even though there's a mass of liquidity out there. I mean, you can see the Fed's balance sheet has gone from roughly $1 trillion in the middle of 2008, spiked up all the way almost to $4 trillion. This is increasing by $85 billion every month, and there's a mass of liquidity. It's just not going anywhere. It's not being used. Banks aren't lending it out. There's very little economic activity happening in regards to money movement and loans. And so that's why we don't really see the inflation and any increases in QE. You know, you can see here every month they're doing this $85 billion. That's this steady, steep increase here. But you can see that basically all of that increase is really just excess reserves building up. So they're really pushing on a string right now. The $85 billion is not making that much of a difference, but it's more psychological, if anything. When they start to taper, bond markets are reacting. And so we need to be careful of the bonds we're holding. We need to be careful, unfortunately, of the stocks we're holding, because if they come out and do something that is not in line with market expectations, there could be some quick movements with stocks and bonds. And so we just want to be cognizant of that. Here's a little bit better picture of the banks and how they're not lending. You can see that the lending standards have improved, but that means banks are only approving people with very good credit scores. The average credit score on an approved mortgage was 748, the average FICO score. Even though demands for loans is increasing, both small and medium and large firms, we're seeing an increase in loans. Banks just aren't willing to do it. And if they do it, you've got to be a very good borrower in order for them to do it. Delinquency rates are coming down a little bit, but you can see common equity as a percentage of total assets. This is basically safe capital that banks have on their balance sheet compared to total assets is at 11.1%. The average of this ratio is 7.6%. We haven't seen 11.1% since the Great Depression. So banks are being very conservative. They're being very stingent on who they give money out and why they give money out. And so this is one of the reasons that we're not seeing a lot of economic activity, any of the animal spirits, because banks just aren't lending. And leverage rate, everyone's worried about deleveraging. Let me give you a hint. We've deleveraged. I wish I would have put one of the slides in here, but leverage has gone from roughly about 160% all the way to about 100% over the past couple of years. Banks have learned from the financial crisis. They're still not eager to increase their leverage. So that as those things start to increase and as banks start to lend, we believe economic activity can really pick up, and that's going to be positive for stocks in the long run. I put this slide in here just to show us this recent spike up in interest rates. That's a really big move in a very short period of time relative to history. Also, I wanted to point out we no longer have negative real yields. Negative real yields are very infrequent because logically they don't make a lot of sense. This is saying that somebody was willing to tie up money for 10 years and be able to buy less a basket of goods 10 years from now, less of a basket of goods than they were right today. So they're willing to lose to inflation over a 10-year period of time. That doesn't happen very often because it doesn't make a lot of logical sense for somebody to park money only to buy less 10 years from now. You can see it's only happened over the past 50 or 60 years. Since the 1950s, it's only happened 3 times. And we just went through this last period of time, and you can see real yields have spiked up, but we're still not even close to what the average real yield is. We still have 1.5%, 2% on real yields before we get back to the average real yield over this time frame. Now, how will interest rate, this is one of the biggest questions we get is, okay, well, you know, I've got this bond portfolio. How is an increase in interest rate? You guys keep talking about interest rates increasing. How is that going to affect my bonds and my bond portfolio? Well, this slide really paints a good picture. We've got treasuries up top. We've got all other kinds of bonds down below. We know that a 2-year treasury is going to have a much smaller impact in increasing or decreasing interest rates. So the interest rate sensitivity of a 2-year treasury versus a 30-year treasury is much less when you compare the two. If interest rates increase by 1%, a 2-year treasury would go down about, the principal of a 2-year treasury would go down about 2%. A 30-year treasury, the principal would go down by about 19%, just to give you an idea. Other types of bonds that are out there, floating rate convertibles and high yield are less interest rate sensitive than investment grade corporates, municipals, and emerging market debt. So as you can imagine, with our stance that interest rates are going to be increasing, we have a lot more focus on these parts of your portfolio and short-term safer bonds versus munis and interest rate, or I'm sorry, investment grade corporates and emerging market debt. We're much more influenced by floating rate, high yield, than we are some of these other ones. Another comment on interest rates in relation to stock prices, this chart maps out the correlation between interest rate increases and what stock returns do during those periods of time. And you can see that there's a difference between those depending on where rates are. Currently, rates are at about 2.6%, so let's say we're right here. There is a positive correlation between an increase in interest rates from where we are now and stock price movements. So as interest rates increase from these levels at 2.6%, history would tell us that the stock market would also increase. Makes perfectly good sense. If the economy is improving, stock prices are going to do well, interest rates are going to have to increase. Once we get to 5% yields, then that starts to have a negative correlation. So as interest rates get above 5%, the more they get above 5%, we actually start to hurt equity price movements. So we just added this slide to know, okay, well, at 2.6, increasing interest rates, not a bad thing for stocks. Very good. Stocks and bonds are a very good hedge during this time period because as interest rates increase, hopefully our stock or our aggressive portfolio will do well to offset the bond portfolio lagging a little bit. That's exactly why I put this slide in here. Show that relationship. International. International has done relatively well this last quarter. You can see emerging markets and developed international outperformed on a price movement basis the S&P 500. But there's more to it than just that because they've underperformed over the past 3 years to the S&P 500. And you know, we need to make sure we know why and why we would want to overweight international versus domestic now this slide right here is one of the reasons. Europe took a little bit different approach. They decided paying now was more important to their long-term plan. That's why they had some austerity programs versus fiscal stimulus and monetary policy stimulus. You can see that because of this, they went through a double-dip recession. Not only did they go into a recession when we went into a recession, but most recently they also have gone into another recession. Now, the pain has been felt in some of these European countries. We believe that there are good valuations and stocks look very attractive in some of these countries. So that's one of the reasons we wanted to show this is it doesn't, just you've gone through the pain. The stock prices have moved because of this. Now as we improve and we have less austerity, we can actually have the stocks of these countries do relatively well. This is another slide showing the austerity. Over the past 3 years, the Eurozone has had about 3.3% drag on their economies. Well, the next 3 years, they're only going to have 1.1% drag. So similar to the U.S., where the U.S., the deficit went from 6.8 to 3.9, we're going to see a little bit of a tailwind because of that. The European countries are going to see a big tailwind because of this, because this is a big number here that we've decreased. So they've already gone through that pain. They're going to have less pain to go through. Sovereign spreads have come down significantly over the last year. Has everything to do with a more stable Eurozone. The long-term refinancing operations that occurred helped tremendously. And then the second thing that they did was the outright monetary transactions. Those also helped calm the European markets down. So you can see that sovereign yields have come down dramatically, which is going to lend to a more stable Eurozone, which gives us a little bit more confidence that we can, put some capital, overweight some capital into the international markets and take advantage of some of these valuation opportunities that we see. Global economic growth, we're getting back to a little bit normal levels in the developed countries. You can see the last couple of quarters, not so great, just barely positive versus Q3, Q4, and the beginning of 2014. We're starting to see a pickup here in the estimates. Emerging economies, pretty much flat, but that's not necessarily a bad thing. They're still above 4%, so they're still the driver of economic growth when it comes to the world global economic growth picture. Here is a chart that's very colorful. We want to avoid reds. You can see that a lot of the reds in the Eurozone are kind of fixing themselves here. Numbers that are over 50 mean that we're expanding here. This is manufacturing momentum, the Global Purchasing Managers Index. Green numbers are well over 50. Yellow numbers are right at 50. Red numbers are below 50. So green means we're expanding at a really good pace. Yellow means we may be expanding or kind of just running very neutral. But you can see that there's a lot of improving numbers here in some big economies. These tend to give us future, these are leading economic indicators, and they look, if you look at them as a whole, they look pretty positive. Monetary policy around the globe, we've already talked about the U.S. You can see Europe, although they had some monetary policy directly after the financial crisis, they've kind of pulled back a little bit, versus Japan has just put on the accelerator. Abe economy is in full force, and they're not worried about inflation at all. They're trying to re-stimulate the economy by reflating the economy. And you can see the U.S., we're starting to creep up here with the $85 billion per month. But just different ways to approach it. You can see Europe, and we already talked about Europe, went into that double-dip recession, whereas Japan and the U.S. have not. Some of the attractive returns that we're talking about, the EFA index is still 37% below its peak that it reached in 2007. The emerging markets are still 22% from their peak in 2007. So we think there's some opportunities here. Valuations. Valuations, if you were to look at history, look relatively in line or neutral. But in the context of the low interest rate environment that we have, valuations are relatively still cheap in our opinion, relative to fixed income alternatives that we have. You know, are you gonna put your money in the S&P 500 earning 2.1%, or are you gonna put your money in a 10-year Treasury earning 2.6% with no upside potential? Or do you want the upside potential of you know, companies that are improving their profits? So we still believe in this interest rate environment. It's very pro-growth, pro-business environment. We believe profits can still increase, although we do want to be careful and maintain an eye on where profits are. I'm going to talk about those here in a little while too. Emerging markets, same story. They're even in a historic perspective, they're still undervalued with the low interest rate environment that we're in. I would say that they're even more so undervalued than developed countries, and that's why we are increasing portfolio exposure to emerging markets slightly. Equity and REIT dividends, like I said, you know, where do you want to be? Do you want to be somewhere where you're earning 2.1% with the upside of U.S. companies, or you know, international companies? You can see, with the exception of the U.S., most of the other countries here, we have dividend yields that are above the 10-year government. So I mean, where are you going to want to put your money? Are you going to want to put your money in a 10-year government with no upside potential, or are you going to want to take a little bit of volatility, get a decent dividend yield, and have the potential for your money to grow over time? Same story with REITs. So we do believe that this is going to drive investors when they're looking at their different opportunities that they have. They're going to tend to favor equities and aggressive type assets versus safer bond type assets. There's still a ton of cash on the sidelines. I can't stress this enough. Even though we're much lower than we were at the March 09, when the S&P was at an all-time low, investors had an all-time high amount of cash. Even currently where we are now, even though the S&P 500 is at all-time highs, we still have as much cash or pretty close to what we had in the 2000, 2001, 2002 recession. So you know, these numbers, this cash number is can come down more than it has. Investors at some point in time are going to get sick and tired of earning less than 1% on their cash, and they're going to see equity returns doing well, and at that point it might be too late. But right now we still have a lot of room. There's still a lot of cash on the sidelines. So a lot of people are underinvested in this rally, which also tends to give us more confidence that the equity market still can go a little higher than where they're at now. This is also a very good depiction of what we're trying to say here. Since 2007, there's been roughly $1.4 trillion into bond funds versus $0.4 trillion into stock funds over that same period of time. You can see massive, the amount of flows into bond funds has dwarfed that of stocks. But look at what's happened over the more recent period of time. Stock funds are starting to outpace bond funds. Not by a lot, but we're definitely starting to see this pick up. And we have all of this kind of unwind here. And it's going to unwind pretty quick. You can see here this summer when interest rates started to spike and people started to lose money in their bond funds, they started exiting them. And they started to see, you know, oh, the S&P's up 20% for the year. I might need to go and put some money in there. So you've got a lot of money in bonds and a lot of money in cash, and not very much money has been put into stocks yet. Now, with that said, October, just to give you an idea, October was a very good month for the S&P 500. October saw $60 billion. So for the 7-year period of time, we had $400 billion go into stock funds. In October alone, we had $60 billion go into stock funds. So that should show you which direction we're going here. And I would argue that we have a long way to go, both in cash and bonds, before we have a lot of people truly invested in this stock market. And at that point, you know, valuations probably will be a lot more rich, and it might behoove us to kind of go the opposite way of the herd. But right now, the herd is not really in stocks. So, you know, for those that are worried about the level of stocks, this is another reason why we're not as worried, because there just hasn't been a lot of buy-in on stocks yet. Just another way to look at the same bonds versus stocks and where more attractive rates are. We flip the price to earning multiple on its head and get the earnings yield. You can see the earnings yield of the S&P 500 is at 7% versus the Moody's Baa bond yield at 5.4. Looking long run here, you know, these things are in line except for 2 periods of time over this 20, 30-year period of time. Back in during the tech bubble, where bonds were significantly undervalued. You know, to get an 8% bond over this period of time as interest rates were going down, you would have been really good to have bought bonds at this point in time and sold stock. Well, exactly the opposite thing happened during this last recession. It would have been a very good investment strategy to have bought a lot of stock when the earnings yield was high versus the bond. And we're not even, you know, we haven't even gone back to an equilibrium, but we're getting closer. That gap has definitely come down, but there still is some room to go on that gap there. PE multiples, short run, they don't tell us a lot. You know, you tell me what the PE multiple is. I can throw a dart at the dartboard and tell you what the return's going to be. You know, if we're at 15, I have no idea where returns are going to be over the next 1 year. And that, I mean, that goes for any metric that you're looking at. There's no one has figured out how to time the stock market over a 1-year period of time. It is a crapshoot. We don't know what's going to happen over the next year. We do not want money that needs to be used next year to be in the stock market or to even be in the bond market. You know, before we even start to talk about bonds, we should really look at 2 to 3 or to 4 years out, depending on the type of bond. And for stocks, we should be at least 5 years, if not 10 years, to use that money in order for it to be exposed to the stock market. Now, if you tell me what the PE multiple is and you say what's going to be the 5-year annualized return, I can do a much better job of predicting what the 5-year average return is going to be. You can see that there's a much stronger relation here and a linear regression analysis from the 5-year annualized returns versus the current PE multiple versus the 1 year. So, you know, if we're at 15, you're still looking at a lot of periods of time that had some really good equity returns when the PE multiple was 15. once we start to get above, let's say, 16, 17 on the PE multiple, now we want to start being careful because we're not really getting paid as much over the next subsequent 5 years to take that type of risk. We're not close to that yet. We're still well below that. S&P 500 earnings. Third quarter looks like we've got a majority of the S&P 500 companies reporting, and it looks like we're going to have a third quarter in a row of record quarterly earnings for the S&P. We've had 11.9% growth in earnings per share over the past year. A lot of that has to do with strong buybacks. Earnings per share, the divisor there is shares. If companies are going in and buying their shares, there's less shares. So if you have the same amount of earnings, less shares, you're going to have more earnings per share, which they're, so buybacks definitely help the remaining stockholders because that earnings per share number goes up, which then should equate to a higher stock price. But getting back to so we've had almost 12% growth in earnings per share. About 9% of that is due to margin expansion, which some of that's buyback, some of that's cost reductions. 3% of that is revenue growth. So, one thing we do want to keep our eye on is it's going to be hard to keep growing margins by 9%. So we're not going to expect that going forward. Wage prices are going to be more of an issue going forward, and we're not going to be able to see as much benefit from margin expansion as we have in the past. Now, with that said, some of the preliminary numbers for next year are $120 to $130 per share in earnings for the S&P next year. So we look at this and we say, okay, well, let's look at this box here. Between a 14 multiple and 1540 on the S&P 500, and let's say a 16 multiple and $130. So we've got 110 to 130 and a 14 to a 16. So the S&P 500 should be somewhere in between 1540 and 2080. I know that's a big range, but that probably gives us a good idea of where we should be. A pretty good indicator of where we should be currently. Maybe let's say 1800 is kind of where we think intrinsic value is on the S&P 500 from our work. Now we're at 1750 right now. This is looking at next year's earnings. Next year's earnings, we could make a case for somewhere between 1800 and 2000, 2100 on the S&P 500. So, that definitely is putting us in the camp of being a little bit more bullish on equities versus fixed income. We will be doing a rebalance for everybody at the 1800 level. We've let the portfolios kind of run on the equity side of things, and at the 1800 level, we are going to go ahead and do an active rebalance. Should that not happen before April, we will do one regardless, because at that point it'll be a year since we did the last rebalance. So just to give you guys an idea of what we're expecting going forward. I always end with some of these slides here. More diversification is better than less diversification. We can eke out a little bit higher return with less standard deviation, which is just another word for risk. And we want to make sure that we have time in the market and we don't time the market. We've had several examples of folks trying to time the market and actually costing them money. Ironwood has seen it personally, but Dalbar has done this with many investors by looking at mutual fund flows, and they've done a study from 1993 to 2012. The average investor's return over that period of time has been 2.3%, which is just about 6% less than the S&P 500 if they would have just bought and held. Now, we'd never want to just buy and hold just the S&P 500. We want to take a more diversified approach so that we can hopefully get a little bit better return with less risk. than just purchasing, one of these things or three of these things. So it's a combination of diversification and then also having the right portfolio for your investment horizon and your investment objectives and goals. This is another slide showing the importance of time. Like I said before, if we have a 1-year period of time, we need money next year. You will not hear anyone from Ironwood telling you you should put it in the bond or stock markets. 1 year, there's just too much volatility in both the bond and stock markets for our potential outcomes. If we need that money for a house down payment or for our retirement income for next year, whatever the case may be, we do not want to lose 37% of it and have to deal with 37% less of what you were expecting. That money needs to be in very safe instruments, money markets, cash equivalents. If we look at 5-year periods of time, now we can start to build a portfolio of maybe some stocks and bonds that we're going to put the odds in our favor. There hasn't been a single 5-year rolling period of time when a 50-50 portfolio has lost money over this period of time, 1950 to 2012. Every single 5-year rolling period, the worst period would have been a 1% return in a 50-50 portfolio. The best return would have been a 21% return. So now, if you give us 5-year time horizon, now we can start to look at stocks and bonds and build a portfolio that's diversified where we put the odds in our favor, time in the market, not timing the market. You put this out to 20 years, now stocks look very attractive because now we can get between 6, if we look at the 20-year rolling period over this period of time, the worst 20-year rolling is 6, the best is 18. Wow, that would have been an awesome time. And then we have some averages up here. Stocks and bonds in the 50-50 portfolio growth of 100,000 over 20 years. You can see stocks would have been the best at 10.8% over this period of time. 100,000 over 20 years would have become almost 800,000. A more conservative 50-50 portfolio would have averaged 8.9%. $100,000 growth of $100,000 would have grown to be $555,000. So you can see that returns are important. We want to make sure that that we have the appropriate time to get the appropriate return. And retirement is a very long period of time. We need to make sure that we're not just sitting in cash earning 1% or less, because that's going to be very hard to hit your retirement goals by doing that. You've got to have a ton of money saved to protect yourself from inflation if you're not taking any risk with your money. So enough on that. This last slide here, I just wanted to show people that even though we've had a good 4-year period of time, we've still seen some volatility. The average intra-year drop is 14.7%. So we have a period of time during the year where on average we go down almost 15%. That's a pretty substantial drop in the S&P 500 during the year. But annual returns, despite that, 25 out of 33 years, we have had positive returns. Now, the last 4 years have been very good. 2009 to 2013, been very good. But look at the intra-year drops we've had to endure. In 2010, we had a negative 16% fall sometime in that year. In 2011, we had a 19% downturn. In 2012, we had a 10% downturn. Now, 2013, we've been lucky, and we've only had a 6% downturn as of now. And so far, year to date, we're up more like 25%, not 18%. But you can see there's still volatility in the market. We always have volatility. There's always going to be some periods of time where we go down a bunch. We should expect to go down in the year. It happens all the time. So in order to get through those time horizons, we need to make sure that we have assets that are going to do well no matter what, and assets that are going to do well over the long run, and put those assets together so you can give yourself the right time frame, because we will go through volatility. We have in the past. We will in the future. We want to make sure that everybody puts the odds in their favor and makes money over the long run. And to do that, we really need to make sure that we're not getting so caught up in the intra-year, yearly returns, but really, what have I earned over the 5, 10-year, 15-year period of time? Those are the more important things. Build a portfolio that matches your time horizon, that matches your investment objectives, and matches your cash flow needs. So what does that mean for our portfolios? Not much different. You know, we're still in the same relative environment that we've been in. We believe commodities have taken it on the chin and have unfairly taken it on the chin. We still are overweight commodities. Floating rate bonds, we still believe that going in the future, floating rate is going to have some tailwinds because of interest rate increases. Market neutral, we like a little bit better than maybe some other fixed income, so it's just another play to give us a safe or a safer type of investment, lower risk type of investment versus bonds. And then, like I said before, emerging market equities seem undervalued in relation to some other opportunities we have in the aggressive space. Underweight, we're underweight fixed income as a whole, especially long duration. Underweight safer type bonds, we would rather own credit because you're getting paid a little bit more for that. Precious metals, although gold has come down a bunch, it still is relatively overvalued in our opinion. And then REITs, not as much of an underweight now. They took it on the chin earlier this year because of interest rate increases. We think they're probably more neutral weight for us now versus underweight, but that gives you an idea of kind of the investment implications there. Long run, over the last 10 years, an asset allocation portfolio made up of, let me pay the lawyers again here, 25% in the S&P, 10% in the small cap, 15% international, 5% emerging markets, 25% in bonds, 5% treasury bonds, 1 to 3 month treasuries, 5% in market neutral, 5% in commodities, and 5% in REITs. If we had that portfolio over the last 10 years, we would have still made 8.1%, which is not, which is not horrible, and that's through one really, really bad recession. I guess the other recession in 2001, 2002, it's kind of fallen off there. But you can see that no matter what asset class we pick, there are some good years. Like look at emerging markets, best asset class in 2003, 2005, 2007, second best in 06 and 04, first best in 09, but 2008, worst. 2011, worst. So it's really not about which asset class is going to be the best next year. It's really about putting them together so that we can really smooth out the ride here. This asset allocation portfolio, never really been the best, never really been the worst, but you end up getting a pretty decent rate of return when we're all said and done. So with that, I'll open it up to questions. Like Nick said earlier, you've got a little box in the bottom right-hand corner of your GoToMeeting panel where you can ask questions. I'm going to have Nick go through those at this time.
Thanks, Dean. I think we should give a few moments for people to compose their thoughts and see what type of questions they may consider asking in light of your presentation this evening. We do have a kind of a fun question that one of our webinar attendees has posed. I guess we can put this out there. And this is really for Scene. One of our attendees wants to know, if you don't place within the top 3 in your division for the Arizona Ironman, will you refund our investment fees?
Oh, geez. I already know who asked that question, too. Well, just to give everybody an idea, and this is being recorded, so I apologize to anybody who's watching this via recording. I am doing the Arizona Ironman in about 10 days. And no, we will not be. I think Ryden and Alex might be mad if I don't qualify and we have to reimburse fees, so I can't say that. But thank you for bringing that up. That made me laugh.
Okay, Sean, we have another question.
All right.
What about housing market rent versus ownership? Does housing still look attractive to you?
Yeah, and I've had this in previous slides. We've looked at rent versus mortgage. Ownership still is more attractive at these levels. We did see a spike up because of the interest rates, but there still is a gap between rent and mortgages, and it still favors ownership at this point in time. But that gap is much smaller than it was. So that's going to be something that's going to be a headwind to housing as when it's not a clear-cut better choice than renting. You might see some slow, and that's why we really want to keep an eye on interest rates, because housing really, the recession of 2008 started with housing. The recovery thus far has been in housing. Housing is a very important piece of the U.S. economy. There's a lot of jobs tied to it. As interest rates stay low and housing is it looks attractive, a lot of pieces of the economy are going to benefit from that. So we definitely want to keep an eye on what the Fed's doing, how the bond market is reacting, because it will have a long-term effect on the economy.
Thank you, Sean. I have another question here to pose. What do you think about oil? It seems like it may be a good buy price. What's Ironwood's position on oil right now?
Well, like I said before, we think commodities look attractive, excluding some of the precious metals. But one of the things that's playing to oil is the fact that the U.S. has really become energy independent, or not quite energy independent, but we're going more in that direction because some of the shales that have been found and some of the fracking procedures have really improved the way that we get oil out of the ground here in the U.S. And there's been a huge amount of supply that's kind of been brought to the forefront because of some of this exploration, and that has had a negative impact on oil prices, which is positive for gas prices because they go down, and now folks have that much less to dole out monthly for their gas expenses and transportation costs. So although I'm not as optimistic as some of the experts are when it comes to U.S. independence and how much supply is really going to be brought online, I think oil has been negatively impacted by this, and I think commodities in general should do a little better than they have in the coming years, especially if the Fed continues to be easy like they have been.
Thank you, Sean. It seems that we have no further questions at this time.
All right. Well, thanks, Nick. Thanks, everybody who has listened to the webinar. We will see everybody next quarter or at the beginning of the year. Have a great end of the year, and Happy New Year.